Global jitters weigh on the street even as the benchmark attempts to edge into the positive territory back above the 24,000 mark, but underperforming broader indices. Real estate stocks are the biggest drags today, while FMCG, metals, autos and defense names hold on to gains. Walcott surges after a sharp turnaround to profit with strong margin expansion. Sobha gains despite a mixed Q4 supported by robust sales momentum, while Tata Technologies jumps on strong growth and margin expansion. M&M posts a strong Q4 with profit surging over 50% and revenue up 25% year-on-year. EBITDA also saw healthy growth, though margins were a slight miss. The company has declared a final dividend of 33 rupees per share. L&T is expected to post a mixed Q4 with strong revenue growth but pressure on margins and profit. Execution on West Asia and domestic order inflows remain key, with a robust order book providing visibility. Tata Sons board may see a key change, with Bhaskar Bhatt likely to be nominated by Tata Trust. He could replace Venu Srinivasan, with discussions expected in upcoming board meetings. Hi there, good afternoon. You're watching Closing Trades on ET Now. I am Snehi Shah. With me in the studio is Harsh Saita. And let's take a look at what the markets are doing at this particular hour. Markets have recovered from the day's low nominally, but still we're under pressure of about 0.3%. 24,000 looks like something we've held on to for the time being. 24,044 is where we're at on the Nifty. Sensex 0.3% lower. It's the broader end of the market where the recovery has been sharper, because you do have the small cap index that's back in the green, although very nominally. Mid cap is also absolutely flat with only a tinge of a negative bias. The India VIX has cooled off 1% right now, around 18.1. Nifty Bank also very good recovery coming in from the day's lowest point. Let's pull up the intraday chart of the Nifty Bank, because that index was under pressure for the better part of the trading day, about 1% cut over there. And just look at the kind of recovery that we've seen from the day's lowest point for the Nifty Bank, about 0.2% lower, and now only a 100-point cut coming in on the Nifty Bank. Within the Nifty 50 group of stocks, it's about 18 stocks that are in the green with 32 in the red. So the favor is towards the declines as we speak. It's Jio Financial, Coal India, Eternal that are some of the top losers. On the flip side, M&M is the top Nifty gainer on the back of good set of earnings. Ultratech, Nestle, Bajaj Finserv are some of the top gainers as well. Sectorally also, it's a mixed bag coming in, because you do have yesterday's top sectoral gainer, that's Nifty Realty, that's under pressure as we speak, followed by banks, finance and IT. And on the flip side, defense is doing well today, followed by auto, pharma, FMCG and PSU banks, with metals, media and energy being absolutely flat. So this is what the market setup is looking like right now. Within the broader end of the market, the Nifty 500, it's actually quite even Steven in terms of what the advanced decline ratio is. It's names like Credit Access, CAMS, Walcott, Titagarh Rail, most of them are earnings candidates. All of them are doing very well. In fact, Credit Access is up 13% as we speak. And on the flip side, it's Aarti Industries, CESE, JP Power, Syngene, Ola, Godrej Properties that are under pressure anywhere between 4 and 6%. So this is what the market setup is looking like right now. And we also have Kunal, who's joined us in the studio with us. Kunal, give us a quick take on how you've read the expiry date charts today. We were under pressure. We've seen nominal recovery from the day's low, but we continue to be under slight pressure for the Nifty.
Yeah, Sneh. So, in the morning, we were discussing that 24,000 is where I would expect the markets to hang around to for a good part of the trading session. I think it's a good sign that we are just hanging around that 24,000 mark, even though at a point where we were down almost 200 points on the Nifty. And what had happened was, at the point when the index was at its day's low, approximately 23,800 on the mark on the spot levels, the put-call ratio had come back to 0.5. Now, put-call ratio of 0.5 is considered to be a very oversold or a deeply oversold market, and which needed kind of a relief rally or a correction in itself. So I think in that sense, we're seeing a bounce back from the deep oversold territories for the indices. And I think the Nifty's come back towards 24,000 mark. But we're still not out of the woods in terms of this consolidation, because if you look at it largely over the last 4 days, we've been stuck into this 400-point band, 23,800 as a support and 24,200 broadly as a resistance. So From a short-term perspective, over the next maybe 1 week or so, expecting the index to remain to this 400-point range. But from an intraday perspective, I was just expecting the index to consolidate and expire, the weekly expiry to be around 24,000 mark.
Kunal, if you do, what's the view with regard to crude? Because I think that's where the linkage of Indian indices is even now. Today, the mild move compared to the kind of move in crude overnight. But nonetheless, it's linked to crude, and therefore, do you have a view there?
Yeah, so far what's happening is, Harsh, crude is neither falling below that $100 per barrel quite significantly, nor it's rising above $118, $120 per barrel mark, which means we are stuck into this 18-point, 20-point band for the Brent crude prices. And so far the indicators, etc., not weakened for crude oil prices to, for the prices to fall significantly below those levels. So which means my expectation is that I think we could probably be now going into the next maybe a week or so, where the crude oil prices could continue to be into this range. So if we come closer to say 118, 120 mark, there could be some selling pressure which could rise. And if we come closer to this $100 per barrel mark, then I think there could be a bounce back of sorts. So which means we are into that phase where the volatility is getting confined into this 15, 20-point band for Brent crude prices.
Okay. Some buzzers in trade today. In fact, let me go across to Karan. He has that entire list of buzzing stocks.
Let's start off with L&T. L&T has won a large order ahead of its quarterly earnings. L&T Energy Hydrocarbon Onshore segment has won a large order from Bharat Coal Gasification and Chemicals, and this is a joint venture between Coal India and Bharat Heavy Electricals. This is for a coal to ammonia nitrate project in Odisha. As I said, it's a large order in the range of 2,500 to 5,000 crores. On that note, the company's order book stands north of 7 lakh crores with a book-to-bill of 2.7 times the trailing 12-month revenue. So do watch out for L&T. Followed by Tata Technologies on the back of its Q4 earnings, wherein the revenue is up 15% at 1,500 crores and the EBIT has surged by 30%. The company is expecting a double-digit organic growth with margin expansion and a steady order book visibility for the near term. IFL Capital is also in focus. While the EBITDA has increased by 17%, the profit is down 38% at 114 crores. The assets under management and custody stood north of around 2.2 lakh crores, and that is up 4% on a year-on-year basis. Moreover, the net margin trading facility book stands at 1,450 crores, and that is up 55% on a year-on-year basis. Idea Forge Tech is extending gains for the second consecutive day. The company had reported a positive EBITDA after 6 quarters, and the company has become the first Indian drone company to train NATO forces, thereby showcasing the company's deep tech defense capabilities on the global stage. And finally, we have LTM in focus, as the company has partnered with Unifor, and this is a strategic partnership focused on the joint development of industry and domain-specific AI solutions that combine small language models, AI agents, and deep domain expertise.
Well, thank you so much for that, Karan. That gives us a sense of some of the buzzers and reasons for that. But Kunal, how would you play the market? What's your stock bias like?
So the NBFC pocket or the financial services is something which looks attractive. Shriram Finance is something which shall be bullish on at the current juncture. I think the stock is looking attractive on this 960, 965 mark in terms of spot levels. Would suggest a buy with a near-term target of 1,000. Stop loss could be kept at 945. The second would be about RBL Bank. Now, even though the stock has ebbed off from the day's high, I think it's 0.5% negative approximately. But I think closer to this 320-25 range for RBL Bank, the stock looks extremely attractive in terms of the trend, because there was a last couple of days back when there was this strong price up move for the stock. There was a breakout in terms of indicators, momentum indicators, which could now play into effect for RBL Bank at every minor dips. So would suggest a buy at the current juncture, targets of 355, stop loss at 325.
Okay, so those are some of the stocks that are looking good to Kunal this afternoon. But let's revisit what the M&M earnings looked like. M&M posted a good set of Q4 earnings, where the top line has jumped 25% on a year-on-year basis. And let's bring on board Shrishti to do the number crunching for us. Shrishti.
Well, a decent set coming in from M&M this time around, when the revenue was in line to what we were expecting at ET now, and so was the EBITDA number, while the margins came in at 14.1%, tad bit lower to what we were expecting at ET now, but the profit is a big beat. 3,737 crores is what the company has reported versus our estimate of close to 3,400 crores. So the profit number is very strong this time coming in from M&M. Now, when we look at the internals, we get to know that the revenue market share leader leadership in the SUV segment continues for the company. In the tractor division, they have gained a 30 basis points in terms of their market share, and the farm and the auto segment continues to maintain their market leadership with 25% jump in their profits and 27% jump in the revenue. Now, when it comes to the auto EBIT margins, they have also come in line at 9.5%, and even the tractor EBIT margins were quite stable at 19.4%. The company has been undertaking many of these capital allocation discipline plans. 3 international firms exit that the company has done, and that was in line to their strategy. So all in all, no major disappointment coming in from M&M, and that's indeed good, and the margins look to be quite steady.
Kunal, what's the take on M&M?
Well, it's still not a buy on my list as of now, Harsh, because the stock is still range bound, and it's rare to see a stock like M&M being stuck into this range for the last 1.5 months. Yeah. I think March second half is somewhere the stock had entered into this band around 3,240 mark as a resistance, and on the downside 3,000 approximately as a support. So to be stuck into this 200-250 point range for a stock like M&M is sort of a rarity. Now, when would the stock likely break out? If it breaks past about either of these two ranges on the upside. So we're looking at 3,240 as the first immediate resistances for the stock on the higher side. However, on the downside, 3,000, 3,040 is a good support for the stock price. So whichever side the stock actually breaks out or breaks down is where I think one should take a trade. Between this range, it's very, very difficult to try and preempt which side the stock would try and move up next.
Okay, interesting. What should an investor do who's already invested in M&M, Kunal?
Yeah, you stay put. It's just it's just that the stock is, it's hibernating. It's taking its own time to try and be into a range.
But that's healthy.
It's healthy for the stock. But the concern is that most of the two-wheeler and the four-wheeler stocks are actually falling into this category. So it's not just M&M. You look at Maruti, stuck into a range. Eicher Motors, which was apparently one of the best performers, that's also stuck into a range. And most of the other stocks, MotoCorp, in a similar kind of a band. So
I understand.
This is what the entire sector is going through right now.
Sneha, you want to take viewers through Marico's numbers?
Absolutely. I've just been looking at those numbers. Largely inline set of numbers coming in from Marico. Revenue, PAT, EBITDA, inline. Slight weakness on the EBITDA front, but nothing much to worry about. It's the margin number that's looking slightly concerning because our estimate was at 16%. It's come in at 15.6%. So nominal softness over there. I'm just taking a look at what the volume growth is, and it looks really good in terms of volume growth because we were estimating a number between 7 to 8% for the India volume growth for Q4, and that's coming at 9%. So anyway, 7 to 8% was supposed to be very strong, and 9% beats that also. So very good show on the volume front. And what's really interesting to know is that the FY26 volume growth for the entire year has come in at 8%, which is a 12-year high for Marico. So looking very good on that front. The constant currency growth on the international business is 19%. We were expecting 22, so not bad. Overall consolidated revenue growth of 22% also looking good. In fact, if I take a look at a Parachute, we were expecting volume degrowth, and that has happened 1% lower. But the value growth of 29% looking good. Saffola mid-single digit volume growth also looking good, and they have gained market share when it comes to value-added hair oils. So all of that looks decent for a company like Marico. I'm just trying to take a look at what the FY27 plan is given by the company. For FY27, they expect to reach high single-digit growth when it comes to volumes, mid-teen growth in the international business in constant currency for FY27, and they're aiming for teens CAGR growth over FY25 to FY27 when it comes to the consolidated business overall. So all of this looks good, and they aim to achieve double-digit revenue growth, which will cross 15,000 crores by FY27 for the entire year. So that's a forward-looking statement from the management. But yes, overall first cut looks like a decent set of numbers. Although the stock saw a sharper fall when the numbers came, but as and when we had more clarity on what the volume number was and what the management outlook is, the stock has recovered a little bit from the day's low, nonetheless about 0.5% lower. But while that's on the numbers, Kunal, a quick chart check on Marico and stack it up versus some of the larger FMCG players like an HUL and Nestle that have already come out with numbers. How is the overall staples pack looking to you?
And Dabur as well. Sorry if I can add that.
So yes, Nestle is the stronger ones. Nestle is the strongest out of the pack so far. I think Nestle was one of the ones, I think at 1300 levels when the results came out, the stock actually managed to see a very big breakout. I think we've moved up 15% approximately, if I'm not wrong, post that result, breakout day for Nestle, and which is a rarity for an FMCG counter to rally in 1 or 2 weeks time span of such magnitude. It tells you that the markets have taken the results with a sort of a resounding positive. Then you look at the likes of HUL, for example. I'll probably rank HUL in the 3 or 4 stocks which you mentioned as maybe number 3 or number 4, because the stock is still into an underperforming spree. It's still trading sub the long-term moving averages for itself. The trend is into a recovery mode, but it's taken a lot of time for the stock to go back into a decent, stronger paced recovery. Marico is something which I would probably believe is second best. The stock is also very closer to its previous highs breakout. 820.25 approximate was the breakout for Marico, trading above the long-term moving averages, still quite strong. Dabur, on the other hand, I think again is the sort of an underperformer. I think at 450, 455, where Dabur is trading right now. It's been one of the most beaten down stocks in the last 5-6 months of this major price correction for the FMCG pack. I remember I think Dabur was almost at 520, 525 when we started off this year. And from there, the stock had fallen down sharply towards, I think, 400, 420. So after almost like a 15 to 20%, a very recent correction for Dabur, it's recovered, just come back towards 450, 455. So there's a lot of recovery for the stock price, which it has to do. As of now, we are not seeing any major signs of price action picking up for the stock.
Okay. That's the take with regards to some of those FMCG counters. What we'll do is slip into a very short break. Come back, talk a little bit with regard to fundamentals. First, we'll have Merrill come in, talk to us about some of those buzzing stocks. Thereafter, we'll have conversation with Deepak Shenoy. Stay with us.
Back with closing trades, and before slipping into the break, we told you that on the other side, Merrill will be joining us with a list of all the stocks that are in the spotlight at this hour. So let's get straight to it. And Merrill, take it away.
Yes, these are a few stocks that we've seen buzzing in today's trade. Starting first with Aarti Industries, in focus after management's commentary on the fourth quarter numbers that they've just put out. Margins are seeing terribly under pressure on the back of raw material costs rising a lot due to the ongoing West Asia turmoil. In fact, they've seen key raw material prices rise up almost 60%, and they're not able to pass through all of these cost increases back to their customers on a timely basis as well. Moreover, their Zone 4 capex, which was a transformational growth pillar for the company, has also been delayed for 3 to 4 quarters, which is why we're seeing quite the bloodshed in Aarti Industries stock today. Moving on, Make Money Organics, on a more positive note, is in focus. The company's gotten approval from the Ministry of Agriculture as well as the Farmer Welfare Authorities. This is for the approval. This approval is for the manufacturing of Nano DAP, Nano NPK, and Nano Zinc, which are all nano fertilizers that the government has been pushing. So this sort of demand push from the government side is a sure shot positive for the company. Moreover, they will not even have to add any additional capex, as the capex that they have in place is enough for these nano fertilizers production. So a strong positive there for Make Money Organics. Moving on, Voltamp Transformers has seen quite a weak set of fourth quarter numbers. Their profit after tax is down almost 50% on a year-on-year basis, while EBITDA has fallen 30% on a year-on-year basis again. But lastly, Wockhardt is also in focus. Revenues were up 30%. EBITDA has grown up more than 3.5 times on a year-on-year basis. The company's biotech business has more than doubled on a year-on-year basis, which is a strong growth pillar for the company. And the management is quite positive on biotech, leading the company's growth into the future quarters and the future years as well. So yes, these were a few stocks that we've seen in trade today.
Thank you so much for that, Merrill. Let me bring on board Deepak Shenoy from Capital Mind. Let me, Deepak, give us your sense first to start off with. I know we spoke maybe a week or two back, and give us a sense as to how you're looking at the current environment. The uncertainty continues to prevail, right, Deepak? And how should one play it at this point? Should you continue to pause? Because a couple of weeks back you had paused. I'm trying to understand whether anything's changed on ground for you.
So I think by and large results that have come in have been kind of meaningfully interesting from the perspective of at least where earnings have gotten hit from the crisis. I think by and large the impact is a lot lesser on the ground, at least from what we are hearing, compared to perhaps what the narrative is telling us, right? So maybe the uh, worst is ahead of us in terms of impact on the economy, but it does not seem like it is as bad as it sounds. We are overall, I think some of the changes in sentiment over there have impacted. So, to that extent, I think some small portfolio rebalancing will happen. The feedback from the market prices themselves, as you've seen, has been very encouraging in the month of April. And, geopolitical worries aside, the market seems to have more or less uh, you know, uh, changed a little bit in terms of sentiment towards the end of the month. So I would say, in general, there is cause for understanding that market sentiment changes will, to a certain extent, describe what we can do in the portfolio as well. And also commentary that from management that will probably drive more, flows into stocks which are relatively unaffected. As you can see, semiconductor names, some defense names, they have been doing relatively better. We've seen more concentration of that in some portfolios. We've also seen that some of the traditionally strong sectors, like say banks and all that stuff, they've had some kind of a recovery. And the data initially, as we've seen at the end of April, we've got March data as well. The recovery in bank credit is quite good. It's their MSMEs have grown 34% year on year. Large industry, which has not been borrowing at all, has seen credit growth of 10.5%, which is the highest since 2013. So to the extent that corporates are borrowing again, to the extent that even retail, maybe a small bump up even in NBFC borrowing from banks, shows that demand for credit is strong, and industrial credit, especially capex, perhaps because credit is kind of like a precursor to capex. That is also kind of encouraging. So in that sense, I think some data that's come in is more encouraging on the bullish side than on the bearish side. We have seen no major concerns so far that cause us to feel that the market's going to be bearish for a significantly long period of time. And typically, market prices tend to move in advance of what happens in the market in terms of fundamentals. So it is useful to pay attention to how market prices are moving as well, especially in core sectors such as manufacturing, like I said, defense, also in semiconductors. These are places where I think there's a lot more action than the narrative allows us to understand from it.
Deepak. And therefore, are you trying to say it's a good time to buy? And if so, what? And if at all one has to play rotation, which is move out of certain sectors, move into others, is there a preference or a tilt?
So I would say, since I can't talk individual names, these sectors generally show a lot more promise. The NBFC sector, in terms of their demand growth, in terms of how much more they're borrowing from banks, and that gives us some kind of a feeling of stability in terms of, okay, there is some movement happening both at the retail and the corporate end. Corporate borrowing from banks is increasing. So to that extent, I would say still focus more on the industrials than on the financials right now. IT is still weak, so I would say that is less a priority right now. However, some of these other stories, from defense, from semiconductors, they can have a multiple jump in terms of revenues simply because the demand seems to be very high. So there is cause for that to be a primary kind of an allocation. So sectoral allocation wise, these might be the better players to allocate to: industrials, import substitution primarily, and manufacturing. My personal preference is, of course, prices haven't reflected this yet, is oil exploration. I feel there is a lot more long-term demand coming in over there, because I think after this geopolitical crisis eases out, we will see a lot more demand for domestic exploration of oil, especially in the basins where we already have discovered have had earlier discoveries of oil and gas. So I think from that perspective, long term, that might still be another area to focus on.
Okay, interesting thoughts over there, Deepak. One theme that you spoke about, oil explorers. Let's take that up with Kunal. Kunal, ONGC, Oil India, when the war began, you did have a very sharp spike up on ONGC. And as and when there was any resolution announced, when the crude prices softened, you had a big cut on ONGC as well. So lots of recent volatility in that chart. But what are the charts looking like going ahead?
The correlation was made and it was broken very quickly. I think in a matter of few weeks only between ONGC and crude oil prices. So it was assumed that, when the crude oil prices were at, they were spiking at $115, $118 and there was this 5%, 10% jump. It was assumed to be that it will be direct beneficiary for ONGC in terms of the stock price, but that stock did not rally.
Yeah.
And even when the stock prices were, when crude oil prices were correcting, ONGC was stuck into a range around this 300 mark. So, just to put it very simply, I think the stock, I think over the last couple of weeks have been consolidating and doesn't look like that it's getting ready for any kind of a big up move, at least over the near term, unless you see maybe a further spike which comes out of blue for the Brent crude prices over the near term, assuming if that's a direct impact correlation which still exists between these two asset classes. Oil India, on the other hand, just as a pure chart, I think that's a slight better chart because the stock showed a lot of positive sensitivity a couple of months back. There was this big move for Oil India from those 420, 425 levels to I think at 1.500 plus mark. But then the stock again has gone to a bit of a shallow consolidation. But relatively, I think the chart is still a little bit more better than ONGC.
Okay, so that's on Oil India and ONGC charts. But Deepak, coming back to that point that you were making on oil, talk to us about what is your medium-term outlook. While it's anybody's guess on how the geopolitical developments shape up going ahead, how should one be looking at oil? What would be a fair prediction to make? Any movement that you're expecting over there in the medium term? Where do you think oil could settle?
So if you look at where we are right now versus where we will be perhaps a year and a half down the line, there are two things that seems to be apparent. First, there is a dip in supply of oil, not so much in demand. So demand is roughly the same. But we haven't seen, and there's a problem in the availability of gas as well. But in the medium term, once the crisis around Iran is resolved, I believe that the supply of oil will increase, not decrease, quite substantially. And when that happens, it's possible that even Russian oil is back into the market meaningfully. There is also a significant amount of oil available from the US. The Middle East itself is fractured internally in terms of keeping supply down, which is what OPEC used to do, versus UAE saying it wants to get out of OPEC. So it will want to supply more oil. The domestic discoveries and exploration by different countries, including China and India, which will perhaps in the medium term add more to supply. I would say the long term or the medium term impact on oil is prices should moderate quite substantially from here, go down below the $80 mark as well in a year or so. But it will take a year before all of these things kind of come down. Gas prices should also come down quite meaningfully. It is a El Nino year, so to the extent that demand in India and other places for energy goes up, there will also be a reduction in demand towards the winter months in the US because typically those the El Nino years have a different impact on India versus the US and the West. So I would say I don't see any major spikes in demand. I only see that supply will probably increase in the medium term. So you should not have a long-term bet on oil. It's more a tactical play for the next year or so. And I think there will be both opportunities on the upside and the downside to play the oil market in that sense. Therefore, I think any bet on oil remaining at this level forever is probably a very bad idea. And in any case, in the long term, people are going towards electrification. So a lot of the in the vehicle industry, so a lot of those impacts will come a little bit more downstream, maybe 2, 3, 4 years from now, rather than right now. So long term, also my impact. I mean, my assessment is that oil is not going to meaningfully be higher than $80 per barrel.
Okay, so $80 per barrel, that's your long-term view on oil. Let's hope oil recovers to those levels from the 100 plus level that it is at right now. But let's shift focus for the time being and on to an 18 hour exclusive. Sources say the IRDAI is set to release draft insurance distribution norms by May end, signaling a major reset for the sector. The regulator is working on a comprehensive overhaul, and Anurag Shah is joining us with all of those exclusive details. Anurag.
Much awaited reform in insurance sector, that is a new commission and distribution regulation to be reality in coming months, and as per our sources by month end draft of new distribution regulation will be there, and after consultation with all stakeholder, after the wider consultation, IRDA will issue a new distribution regulation, and regulator is not working only on the commission structure reform, but overall distribution space in insurance industry will be impacted by the new regulation. Effort-based remuneration is also considered as a part of new distribution regulations. As we have seen that starting from RBI's financial stability report, from economic survey, concerns were raised on the high commission structure in insurance industry, and taking a note from that only, IRDA is working on it from last few months. The data has been taken up from insurance companies, from brokers to decide new regulation in distribution, because the mis-selling is also a big concern in the insurance industry due to higher commission. There are cases of mis-selling in insurance, but by month end, the regulator will come up with a new draft, and after consultation with all stakeholders, a new regulation will be there, and it will focus on accessibility, awareness and affordability in insurance sector.
Okay, thank you so much for that, Anurag. Deepak, the one really good set of numbers that came out, or rather than the numbers, the commentary, which was extremely positive, was from Tata Technology. We spoke today morning, in fact, about this, and the kind of growth guidance they've given, and the kind of margin improvement that they've given, and the reasoning they've given for that. They've said that US car makers will have to compete with Chinese car makers, and therefore they will have to invest in technology, upgrade their technology to international standards, and for that, the kind of business that a Tata Tech will likely win will be very strong. Give us your sense, your take. Tata Tech, is it a good play at this point? Is this theme likely to play out well? What are the other options in this space that you would likely play?
Yeah, so I guess, there have been a number of players in this space. A couple of other IT names have been focusing on auto tech, non-tech, but device-wise, you got a Bosch as well. So there is a bunch of other players in this space. So there is some kind of a demand for testing, for a lot of, more of an enterprise grade vendor for some of these companies. But I would say, getting into this space is a very difficult, ordeal, in the sense of there are long entry level times, especially for some of the services they're talking about. And while they may materialize, the idea that they will is, I think, I would rather say wait for the orders to come in, to see the size and scale of them, whether Indian companies get those orders, or whether there's a bunch of other technology players who may not be in India, who are there for providing these services, whether some of the some of the other players in this space kind of get together and do something jointly, and that will reduce or change the nature of the effort or the nature of the services that some of these companies will provide, is a little bit unknown right now. So, I mean, it's useful to look at it from that perspective as a potential trigger on the upside, but I would say wait for some data that actually matches that narrative before we would get in. Once the data starts coming in, and we've seen, electric players, EV players in general, the competitive nature of this game has resulted in not magnified profits for many of these players. So just assuming that they will be willing to spend a lot more, while margins haven't really reflected the scale at which some of these things are happening, and plus there are some players who don't outsource meaningfully, so to India, such as Tesla and so on, and many of the Chinese players. So who wins this game, and whether those players, whether the other players have the ability or desire to compete, that's a little bit of an unknown right now. I would say wait for at least some orders to start coming in before we start looking at this meaningfully. It is an interesting space, no doubt, but I would, I think there's a better set of plays out there in plain old semiconductor or industrials in this space, rather than playing on the specific theme of technology upgradation at EV in specifically in the IT names here, IT kind of names here.
Okay, appreciate that take coming in, and thank you so much for your time, Deepak. On that note, we'll let you go. Okay, viewers, on that note, it's time to slip into a very short break, taking a quick look at what the market is doing and has done absolutely nothing since the last 40 minutes, since the last time we spoke about it. Continues to be about 95 points lower, and 24,024 is where we are at on the spot. On that note, time to slip into a very short break. More news and updates on the other side.
Welcome back, and joining us this afternoon is Shivangi Sarda from Motilal Oswal. Shivangi, let's start off by having your view with regard to the market itself. How are you viewing it?
Very good afternoon. So we've seen that the markets have given off some bit from its highs, but overall we have gotten stuck in quite a band from the last 6 trading sessions. Even though support-based buying is quite strong at these levels, we are witnessing some bit of pressure at the higher zone, which is making it capped from the upside. But overall, buy on decline to continue here. We've seen good rollovers in the May series as well, and a lot of sectors are also adding in buying interest. So we would look at 24,000 very closely, and this will be a make or break zone for the index for the next up move towards 24,350 levels, which is the next resistance that we're looking out for. And as a support base, we could look at 23,800 marks for Nifty. However, if we look at Bank Nifty, this one has been underperforming from the second half of the previous month itself. And we've seen that it has been making lower top, lower bottom from the last 6 sessions consistently. And some bit of pressure may remain here till the time it manages to cross and hold above 55,000 levels. So watch out for these levels. Support can be seen at 54,500 and the resistance immediate is at 55,000 levels.
Okay, so that's the reading on the Nifty and the Nifty Bank. Shivangi, before we come to you for some more views of yours on charts, let's focus for the moment and on to an ET Now exclusive. Sources say Bhaskar Bhatt could be nominated to the Tata Sons board by Tata Trusts. The trusts are expected to discuss the move at board meetings scheduled on May 8 and 12, with a final call likely ahead of Tata Sons board meeting in June. Anurag Joshi is joining us with all of those exclusive details. Anurag.
The board of Tata Trusts could consider the name of Bhaskar Bhatt to appoint him to the board of Tata Sons. Tata Trust has an about 66% equity stake in Tata Sons, and the trust's board is meeting on May 8 and on 12. The next meeting of the Tata Sons board is likely scheduled on June 12. If Bhatt is appointed as a director on the board of Tata Sons, he could replace Venu Srinivasan, who is currently a director on the Tata Sons board and also a trustee on Tata Trust. Bhaskar Bhatt had joined Sir Dorabji Tata Trust as a trustee last November along with Neville Tata. Neville Tata is the son of chairman of the trust, Noel Tata, and also the CEO of Star Bazaar. Bhaskar Bhatt is a former managing director of Titan and Company. A key issue which is now before both the trust and Tata Sons is the question of keeping Tata Sons unlisted. The Reserve Bank of India recently came out with norms in which they have defined entities which are in direct receipt of public funds. And this could have repercussions on Tata Sons' efforts to stay unlisted as a company.
Okay, Anurag, thanks for taking us through all of those updates. So yes, Bhaskar Bhatt is a name that you want to be watching out for. We're going to be hearing a lot of this name on the meetings that are scheduled on May 8 and 12, like Anurag was just highlighting. So that's on the Tata Trust and the Tata Sons front. But once again, shifting focus to the market, Shivangi, you were talking to us about your view on the benchmark indexes. Also, give us your sense on some of the sectoral movers. Yesterday, it was the realty index that was the top sectoral gainer. Today, it's the top loser. So sector churn is in full swing. Which chart is looking like the most attractive sectoral chart at the moment? Where are you bullish?
This is the market where the sector rotation should be done very swiftly, and also one should be diversified well enough. But on my radar is two stocks, one of which is BSE, which has been holding quite resiliently. Although it is down a little from the day's high, but overall it has been making higher top, higher bottom. And even on the monthly basis, it's given a breakout from the previous resistance zones and holding quite well at the higher levels with a good divergence from the RSI front as well. So this is one stock which could be kept on radar. We are looking at the next targets for BSE of around about 3850 immediately, and then positionally 3900 levels with a support near 3630 levels. And second pick on my radar would be HAL from the defense space, which has come out of its consolidation for the last 12 sessions, almost like a Poland flag pattern formation breakout. Volumes have been significantly high from the last two sessions, and the closing is quite comfortable as well. So bulls are paving a full, swing over here. So this one would be on radar for the next swing towards 4800 levels with a support at 4520 levels.
Okay, and all right, so those are some names you want to keep on your radar. Let me actually go across to Karan, who's here with regard to what to expect from the print of L&T, because that'll come out with numbers for the quarter ended Q4 FY26. Karan, what is the street really expecting or penciling in?
Well, ahead of the quarterly earnings, let's take a look at what the street is expecting out of the quarterly earnings of L&T. While the EBITDA is seen at 9,000 crores, implying an 8% decline year-on-year, the street is expecting the consolidated revenue growth of 13% on a year-on-year basis. The key monitorables for L&T include the execution of the order book in the Middle East, potential to reconstruct post the war, and the ramp up in domestic ordering and the subsequent margin performance. The street will also watch out for the Q4 order inflows, and remember that the company's consolidated order book as of 31st of December stood north of around 7.3 lakh crores. Moreover, the company had secured orders worth 1.3 lakh crores in Q3 FY26. Based on the order inflows which are disclosed to the exchanges so far, the Q4 order inflows are expected to be north of the range of 25,000 to 52,500 crores. Considering the fact that the company has a substantial exposure towards the Middle East, wherein the Middle East order book exposure is north of 30%, remember that the company had earlier clarified that 95% of the sites in the Middle East are functioning absolutely normal. On that note, it would be really important to see how the Q4 earnings play out for L&T.
Okay, so that's on L&T. Kunal, a chart check on L&T or any other infra name that's looking good on the technicals?
Yeah, I think L&T is something which looks attractive. Thermax has done reasonably well. ABB, Siemens, I think these stocks have been doing fairly well for themselves. So I think the entire cluster of stocks apparently have done very well for themselves. L&T, of course, being one of the top names over here, also part of the Nifty 50, I think holds a lot of merit because many a times I think movement on stocks like L&T, they could probably guide on the direction of where the indices are moving. Specifically on the charts, the stock trading at 4,000, 4,050 levels for L&T is something which I would still believe that it's more of a buy on dips, even on the short-term time scale. For someone who's looking to maybe add the stock on short-term corrections, I think sub the 4,000 mark, 3950 odd levels is a good zone where traders could look at a buy.
Okay. That's with regard to L&T. What about some of the tech names, Shivangi? Tata Technologies, is that at all looking interesting on charts? Let me also throw in a KPIT Tech, some of the other ER&D companies.
So Harsh, looking at this entire pack, of course, there's a lot of momentum from the last 3 to 4 weeks. If you look at Tata Technology or some of the similar stocks in this line, but overall, we've seen momentum, slightly drive away after a few sessions of good momentum. So I would suggest we could wait and watch for this one to, if it manages to hold above 620 and sustain above the same, then we could, do a fresh buying here. But overall, there is some bit of resistances which is still intact in the space.
Okay, so that's on some of those tech names. But on that note, let's slip into a very short break. We'll be talking about more stocks and more top buzzers of the day. We'll be getting a technical check on these names by both Kunal and Shivangi on the other side of this very short break. Back with closing trades, we also now have Mr. Ashi Anand, founder and CEO at IME Capital, joining us on the show. Of course, Shivangi and Kunal are with us. Ashi, I remember one theme that you have structurally been bullish on since a very long time now is platform companies, the internet space, the quick commerce space. Talk to us about how you have read into Eternal's earnings. I know it's been a while since those numbers have come out, but we've got Swiggy at the end of this week. Give us a sense of how you are expecting this sector to perform right now as well as in the medium term.
Yeah, sure. So I think clearly, and we have been quite vocal about this, we continue to see this as the most attractive value creation opportunity in India over the coming decade. The way the core investment thesis is that there is a tremendous level of value migration that is happening across industries away from traditional businesses towards such digital first platforms. Now, as more and more business transactions start moving towards these platforms, not only do these companies scale and scale actually very dramatically, but a large part of the cost of actually building out the business is actually involved in sitting and attracting initial customers, getting them to transact. And a lot of these costs can actually stabilize very significantly as you go along. And therefore, just as you proceed year by year, what you tend to see is high revenue growth continuing and costs being relatively well contained, which leads to fairly attractive kind of margin expansion. And what we see is very healthy profitability levels on very large businesses 3 to 5 years down the line. Accordingly, we kind of see this as the most attractive space within the Indian investment landscape over the coming decade. Now, coming to the specific question on Eternal, if you are seeing a lot of what we've spoken about in terms of the theme you have seen in the overall numbers, so Eternal continues to kind of grow. You've seen the food delivery business, which was a bit muted in terms of growth for a couple of quarters. That growth has started to come back quite strongly. A quick commerce, while certain market participants were a bit concerned about growth rates possibly coming off, they were kind of clocking a 100% plus growth rate. They are now talking about a 60% annualized growth over the next 3 years. It's important to understand that while growth rates are coming off, it is off a much, much higher base. And therefore, absolute levels of growth is very attractive. And Eternal has spoken about a 5 to 6% adjusted EBITDA on the Blinkit business. You're talking about $1 billion of profitability coming as early, say, 2029. Now, this is a business that didn't exist 4 or 5 years ago, and you are seeing kind of $1 billion of EBITDA and arguably a very high level of value that you can ascribe to this. So, at least from our perspective on Eternal, all fires seem to be continue to be firing. You are kind of growing; both businesses are growing quite well. Yes, quick commerce is slightly below the very optimistic projections of the markets, but overall growth numbers still are very strong, and you are seeing consistently quarter after quarter profitability levels improve. In fact, Blinkit has been a big positive surprise in terms of how quickly they've been able to achieve adjusted EBITDA break even. And you're seeing a clear distinction here of Eternal versus a Swiggy. But effectively, if you're looking at Eternal, looking at the overall trends, I think that core investment thesis that there's value migration happening towards these businesses, allowing them to grow substantially faster. A large part of the costs are actually fixed in nature and can actually come down as these businesses scale. You're starting to see that in profitability. And this combination is just very, very attractive for value creation. And which is why we kind of continue to be very positive on the theme. Eternals come out with numbers, they've been quite good. A number of other companies have also come out with numbers. And what you are seeing is this
Hate to
core trend really
interrupt.
continues to
Apologies for interrupting. Actually, I'm really sorry to interrupt you over there. We'll give you some time to finish that point, but it's M&M's presser. Let's, in fact, cut across straight to it. And let's hear out the conversation that he's had with my colleague Sajid.
Let the numbers speak for themselves. Profits up 42% year over year on the quarter, coming off a very strong quarter last year as well. And all our businesses contributed this time. We had Mahindra Finance leading the pack for the year, up 60% for F26 overall. For the year as well, we had Auto up 33%. Our growth gems collectively were up 50% on a profit after tax standpoint. Our farm business up 36%. And if we take the international subsidiaries impairment, then up 13%. And TechM up 14% on a strong path as well. So we've seen all our businesses contribute at a very high level and on a very strong footing at this point, despite the challenges we've seen in the quarter.
And how is the margins? Because the margins have come off a bit actually on a year-to-year basis.
The margins actually have increased. Auto is up 80 basis points for the full year. Farm is up 150 basis points for the full year. And even as we see in the fourth quarter, we managed to keep a very high level of margins overall. So that has really driven performance. It's been volume growth, margin growth, and market share growth.
If you look at FY27, because that's everyone is looking at, how do you see that? Is that a challenging year for you, given the fact that you still have a West Asia crisis, you have supply chains which are disrupted, and then you have the crude impact, which so far hasn't been on many companies, but there could be a second-order impact that will come in?
So the world around us is challenging, but the lessons from COVID have helped us a lot because we've built a tremendous amount of resilience across our businesses. At this point in time, if the ceasefire continues and the war doesn't come back, I think we're in good shape overall. There will be some issues, but on balance, we'll be in a very good shape. And we feel India will continue its strong trajectory as it goes forward. If the war continues much longer, then there will be potentially a greater set of challenges depending on how long it continues for and what are the other global disruptions we see. But at this point, we're fairly hopeful that things will settle down to at least some semblance of normalcy. We will obviously expect some level of shocks to continue. And on the tailwinds of India's growth, we see ourselves as well as many other Indian companies positioned well in this current era.
In COVID, the biggest challenge that you had was with respect to supply chain. And it took some time for you to get over that. How are you managing it now?
Learning from COVID, there was a lot of work that has been done by our teams. We've actually gone through every single aspect of our purchases. We purchase 106,000 crores or 106,000 crores every year. We've got 100,000 parts and 40 commodities that we buy. And we put them through a screen of multiple risks, including geopolitical, single supplier, technology, logistics, regulatory, and identified 82 part families at a high risk, 9 commodities at a high risk, and taken a number of actions to mitigate the risk on them. And that's helped us through this crisis as well, because we have seen supply chain disruptions over the past few months. And our teams have been able to work through those disruptions and ensure that production doesn't really get impacted as a result of that.
And what about the cost and escalation which is there for many of the raw materials which has come in? Are you able to pass it on to the consumers as well?
So we see some aspect of that right now. We feel that that's some aspect is temporary, some aspect will continue as inflation for a little longer. But we're not worried about it a whole lot. We have taken some price increase and that will pass on, not all of it, but some of it to the customer. And some of it may come back. So on balance, we don't really see much of an impact on the customer or on demand.
How do you see volume growth this year in FY27 for yourself?
So what we've talked about is for SUVs, we see mid to high teen growth once again for us. We had said the same thing last year. We delivered 20% growth. And we again see a mid to high teen growth for us. For tractor at the industry level, we see a mid single digit growth. We are hoping we grow faster if we can gain share as we have done before. For LCVs, we see the industry at a high single-digit growth, and both of those are at the industry level. For us, it will hopefully again be a market share gain and stronger growth from that perspective.
How do you look at the EV cycle here? Do you think the adoption will be much faster after this crisis because of the demand that may come in for alternate fuel cars?
Yes, that clearly will help. And we're already seeing a strong demand for EVs on the back of the strength of the products we have. For the quarter, our EV penetration was 9.6%. And if you look at the last couple of months, it's been at about 11%. And this is up from literally 1.5%, 2% about a year or two ago. So there's been a very significant change in EV penetration. As chargers come up, and we put up 100 chargers already on key highways, and we plan to get to 1,000 by the end of the year, we will start seeing a much greater penetration in EVs across.
And what percentage of your portfolio would be EV, maybe in a year of 3 to 4 years?
So what we would want at least in a reasonable time frame, a 3 to 5 year time frame, is that we hit 30% of our portfolio as EVs.
What about the capital allocation for this year, FY27? How much of investments are you looking at in CapEx and in any other investment form?
So we had outlined a CapEx plan for 3 years, which is F25 to F27, which was about 36,000 crore total. And we'd identified auto and farm as part of it. So we are on track for that 3-year plan at this point. And in about 6 months or so, we will outline the next 3-year plan. But we continue to invest, we continue to grow capacity. And that's a function of greater demand. At this point, we are still getting towards the peak that we have in terms of capacity. And by the time we hit that, we will have more capacity on that.
Where are we on that plan? Are you ahead of the plan, or you will have a bulk of the investment coming in FY27?
No, we are on track. It's been evenly spread through the 3 years that we talked about, and we're on track for our plan right now.
And the Nagpur plant, which you've been working on, do you think you'll be able to roll out vehicles by the end of this financial year?
Yes, that will be F28. And we've outlined the timelines for that. But we expect significant capacity addition with the Nagpur plant coming up.
Finally, AI. That's the most disruptor. And I heard you in the press conference saying that there won't be any job losses at Mahindra. How are you adopting AI, and what is the kind of cost efficiencies that's coming in for you?
We are adopting AI across all our processes. So across businesses with our teams, we are looking at how do we increase quality. How do we increase reach by getting to more customers, personalize things for them? How do we enhance customer experience and efficiency? So efficiency is only one aspect of it. Everyone focuses on efficiency and job losses, but that's only one aspect of AI. There are a whole host of other things that AI can do, and that's what we're driving. And that's going to create a much stronger company, a much better customer experience. And we have not been talking about it till we actually could see results from it. We are seeing results now.
In what form? If you can give a few examples
so
of
we look at 3 areas of AI: deploy, transform, and invent. Deploy is people using AI in a number of things with regard to their processes, which you could do in a week or two at most, maybe a month, and be able to deliver meaningful results. This may be as simple as there are regulatory requirements around filling forms in certain areas. An AI agent can do that easily, get it verified by someone. Call center assist in terms of understanding what customers want, being able to provide answers very quickly, and assisting call center agents. In some cases, handling processing of documents in Mahindra Finance, and an AI agent can handle our central processing center documents in 7 minutes as compared to 40 minutes that it would take otherwise. And therefore, it enhances the customer experience. Our objective is to get that 7 minutes down to maybe a minute or so, and have it at the phone where a sales agent can talk to a customer and say, yes, all of this is done and your documents are in order. So there's a whole host of things that we would look at from a deploy standpoint. Transform is projects that have a much bigger impact, and we are tracking the level of impact it can have. Paint shop in auto, we're looking at welding from a manufacturing perspective, and a number of other applications that again enhance quality, improve customer experience. And Invent is setting up AI first businesses. Life insurance businesses, something we're going to set up as AI first, and set up the process from scratch based on AI in terms of claims processing, onboarding customers, and various other things. So we're looking at AI across our businesses. We're doing stuff in real estate and holidays, in our energy business and sustain. And there are multiple uses we've seen of AI that improve what we do. And that's also been one factor in us being able to deliver the kind of results we have.
M&M, in fact, now perked up 3%. So doing very well for itself, especially from the day's lows. Decent kind of move, very strong numbers. Ashi, M&M, Hero, and the Auto Pack, how would you play that in terms of the theme? We've seen a decent rally post the GST rationalization that happened. Do you still believe that there's value on the table left?
Yeah, sure. So in fact, I was quite happily listening to the management's commentary. So we do actually hold M&M in our portfolio, and we introduced auto into our portfolios post the GST cut. What you are kind of seeing is that while the last couple of years were largely driven by kind of cross capital formation, and the last year was actually a muted market, you have a number of measures that are coming together. It's the GST cuts, income tax cuts at the start of the year. You also had a fall in interest rates, and there's a pay commission which is due. All of these are basically coming together, which should be quite supportive of a consumption recovery growth. And within this kind of auto naturally stands as the biggest beneficiary because clearly GST has the biggest implication, and a big cut in the price of a discretionary product can actually really drive demand quite strongly. We've obviously seen very strong numbers through last year. Now, the kind of hope is that this will actually sustain going forward. Within auto, we prefer kind of passenger vehicles. Our concern on two-wheelers is really around the fact that it is likely to be see the fastest shift towards EV, and the eventual market share dynamics and profitability on the EV portfolio is still fairly uncertain. In that context, we kind of prefer playing farm equipment, passenger vehicles, and which is why we've introduced M&M into the portfolio. We are evaluating the CV space. It's been a space which has been subdued for an extended period of time. There should be a CV cycle which does kind of recover at some point in time. At that point in time, companies like Tata Motors or Ashok could actually be quite interesting.
Okay, so that's the take on auto coming in from Ashi. But while we're talking about autos, watch out for Hero Moto. It's all set to report its Q4 numbers later today, and a good set is expected this time around. Better product mix is likely to aid revenue growth. And what more can we expect from Hero's numbers? And more importantly, what is the street penciling in? Let's take it across to Shrishti, who's joining us with the key expectations. Shrishti.
So decent set is expected from Hero MotoCorp this time around, and given the commodity cost inflation, the company could still manage to actually protect their margins. And the biggest of all, or rather the main factor behind that could be the price hike that the company has been taking, because it was not just back in the month of December, but also in the month of January as well as February. The company has taken price hikes, and that can help them protect their margins. And on to the margin front, we are expecting a number close to 14.4% this time around, though on a YY basis it could be a growth figure, but on a sequential basis a marginal decline is what we can expect. When it comes to the profit number, 1403 crores is what we are penciling in. Revenue expected at 12,496 crores, while EBITDA could see a jump of 27%, and 1800 is what we are penciling in for Hero MotoCorp. The export share has actually improved for Hero MotoCorp. The volume growth was quite strong this time around, and yes, on the back of better scale, the margins are expected to do better. So all eyes on that, but critical to watch will be the demand outlook going ahead.
That's on Hero Moto. But while we're talking about autos and two-wheelers in particular, Shivangi, let's come back to you and give us your sense on some of the two-wheeler stocks like a TVS or a Hero or a Bajaj Auto, for instance. Which one is looking better versus the other on the charts?
Looking at the entire auto space, especially the two-wheeler names, we've seen that it has shown a good amount of recovery from the last couple of sessions. even though it has kind of moved in a very narrow band from the last 6 sessions. But overall, there is good recovery and support-based buying intact. Now, looking at this entire space, I think TVS Motor is one such stock which is quite resilient, and it is holding on to the support levels very firmly. So this one would be on radar. Of course, we could look at some of the auto ancillary names as well, but for a very quick short swing. TVS Motor is getting ready for the next move towards 3650 odd levels.
Kunal, defense, what's the take there?
It's spectacular, Harsh, because, it's not just, so you look at HAL and, Mascot, etc., but you look at the other companies, I mean, those stocks have done smaller ones.
MTARTEX, the Idea Forge today, for example, some of those moves are very strong.
Palchar Nagar, I think that stock from 140 has jumped up to 260. So I was just looking at the list of companies with the defense pack, and I think it's a very strong move. And this is,
how do you play it? How do you ride this rally?
I mean, the best way to do is to buy the Nifty India Defense ETF. I think that's the best way to try and ride the trend, because there are, I think, some 7-8 companies, if I'm not wrong, more than that. So you can't be, buying these names. I mean, I'm buying MTARTEX at 6,500, 600 levels.
Exactly.
But is it too late?
It is. To a larger extent.
No, but on the ETF, is it too late?
No. On the ETF, it's not. On the stock specific,
on an individual level, okay.
See, because larger part of the underperformance on the ETF is because names like BEL, etc., they have not moved or participated in the last 3-4 weeks as compared to many of the other stocks. And eventually these stocks will also participate. But right now it's just that such a high confidence move across the defense pack that traders want to maybe jump onto or maybe latch onto the mid cap names first and then try and go back to those larger cap stocks. And that's what I think the juice is so far from the defense pack.
Okay, okay. Kunal's take is you buy the ETF. Shivangi, what's yours?
Of course, this has rallied quite well in the last few weeks. We've seen that, in fact, on the monthly basis, it is holding on to the breakout levels. Now, of course, the stock has rallied quite well, but overall, it is still holding at the higher levels, and we could actually trail our stop losses ahead. This one's quite positive. In fact, the entire space is kind of giving strength to this one towards 6,500 odd levels. So this could be the next levels to watch out here. But of course, one has to trail these stop losses ahead. The next support that we could look out for is 6,150 levels.
So that is on HAL and some of the other defense names that we've been talking about. But shifting focus from defense to consumption once again, we've spoken about Marico. The numbers have come out today and largely inline set of numbers. Volume growth is strong. But the next set of numbers to watch out for is going to be Godrej Consumer, who's got its earnings lined up tomorrow. Once again, we're expecting a very good set from Godrej Consumer as well. And this has been the theme for FMCG staple companies across the board this time around, because you had HUL that did well, Nestle that did well. And once again, Marico has done pretty well for itself. And we're expecting the same from Godrej, because remember, in their update also a few weeks ago, they had indicated a strong performance for Q4. We're expecting the revenue to grow by 9%, EBITDA to grow by 12.5%. We're seeing a very solid growth of 41% on the net profit. And it's very important to remember that the base quarter had an exceptional loss. So if I add that back, then we're expecting to see a PAT expansion of 31%. So that's the difference between the reported and adjusted PAT that you should be watching out for. Where we are seeing some phenomenal strength this time is on the margins, because we're expecting the margins to shoot up by more than 70 bips at 21.7 compared to 21%. If I take a look at what the volume growth is expected to be, healthy between 7 and 8%, so we'll be watching out for that. Good growth is expected in home care, personal care, soaps. Here we are going to be a little cautious because palm oil, which is the key ingredient for soap, we've seen some inflation for that raw material, and the cost of production for soaps has gone up. So they've said that barring soaps and all other segments for personal care, they will see double-digit growth. Soaps is expected to see high single-digit growth. In their Q4 update also, they had said that they're expecting high single-digit underlying volume growth. The estimate largely was 5% earlier, but now it's come all the way up to 7 to 8%. So this is something to watch out for. Other than that, we'll be watching out for any pricing action undertaken already or if the company is planning to undertake, along with their commentary on the Indonesia business that has continued to be weak for them. So we'll be watching out for these numbers tomorrow. But yes, we're expecting a good set from Godrej Consumer this time around as well. But while that's on staples, let's broaden that basket a little bit. Ashi, we've been talking about consumption on the quick commerce front. Give us your sense on discretionary. Let's talk retail, jewelry, travel, consumer durables. Anything looking good from that basket?
Yes, so discretionary consumption has actually been quite a puzzle. What you've seen is a lack of clear trends. There's certain parts of discretionary consumption that have been holding up incredibly well. So I think top of mind is really jewelry. Despite kind of very strong gold price increases, etc., you've not really seen any impact on jewelry demand. So that part of consumption is doing very well. You have travel and hospitality, which is also holding up quite well. But the moment you get out of these few segments and you have auto, which kind of bounce back post GST cuts, large other parts of your consumption basket, right? So a lot of your traditional retail players, you're seeing an Avenue supermarkets, you're seeing a trend. They are all really struggling for like-to-like growth, and there's been a clear slowdown in overall growth. Now, whether this is partly an impact of quick commerce or e-commerce, those markets aren't yet big enough to have this level of a growth impact. So you've had weaknesses in traditional discretionary consumption. You've had weaknesses across branded apparel segments. So it is interesting that after COVID, consumption behavior seems to have changed. There seems to be a lot of spends that have moved towards real estate, travel, and jewelry. And it's kind of come at the expense of some of these other categories. So a lot of people in the markets are waiting for kind of growth to kind of re-emerge in some of these other discretionary consumption names. But at least as of right now, while you are seeing some initial signs, overall growth in a number of discretionary consumption categories are still quite muted.
Okay, Ravinder here with some stocks and some of those buzzers since the afternoon, at least in terms of earnings and otherwise. Ravinder, what's on your list?
Well, as after reporting its Q4 FY26 earning, Marico is in focus, and company reported an overall inline set of number in Q4 FY26 where revenue grew by 22% on a yearly basis at rupees 3,333 crore, while EBITDA margins was declined from 16.8% to 15.6%. And if we talk about the volume growth of India business, then India business registered a volume growth of 8% in FY26, which is highest in 7 years, but it was slightly in line with the street estimate, as street was estimating a volume growth of 9%, and company remained very optimistic for the future growth. They said that the company, they said that the business, India business has sustained high single-digit underlying volume growth in Q4, and they expressed confidence in maintaining the similar in FY27 too. And Marico expect to deliver healthy volume-led revenue growth, targeting double-digit top-line expansion to cross 15,000 crore in FY27. PNB is also in focus on the back of the inline set of number where NIMS was declined for around 4 basis point on a sequential basis from 2.65% to 2.61%, and NI also degrew by 3.5% on a yearly basis. Alkali Amine is also in focus after its Q4 earnings, where company's profits saw a decline of 1.5% on a yearly basis, which was in line with the street estimate, and EBITDA margin also has increased from 17.7% to 18.2% on a yearly basis. And if we talk about the revenue, then companies reported revenue at rupees 386 crore, which was flat on a yearly basis, and the revenue was above the street estimate, as street was estimating a revenue of 328 crore and the actual revenue was 386 crore. And lastly, and MQR Pharma 2 is in focus on the back of the earnings, where company's revenue grew by more than 16.5% on a yearly basis, and profit also grew by 29%. But EBITDA margin has increased from 19% to 19.4%. So back of this, MQR Pharma is also in focus.
Okay, Ravinder, thanks so much for taking us through some of those latest stocks and focus on the back of their earnings. But while we're talking about earnings, let's refocus once again to auto. We have too much happening in that sector. And let's take a look at Bajaj Auto. Shashti is joining us on the show with what to expect from their numbers tomorrow. It's the only Nifty company to come out with its earnings tomorrow. So all eyes will be on Bajaj Auto. Shashti, over to you.
Yes, all eyes will be on Bajaj Auto. This time around, we are expecting a good set because on the back of the volume figure that the company has reported, where we have already seen a 24% jump in their overall volumes on a YY basis, and sequentially as well, it was a low single-digit growth. When it comes to their internals, it was the higher share of the three-wheelers over 125cc motorcycles. They continue to do well, and the company has registered a 39% growth in their export of the three-wheeler segment and 23% YOY growth in the two-wheeler exports. So all in all, it seems to be all gun blazing for Bajaj Auto, and the numbers are expected to be quite strong. And on the back of that, the margins are expected to be steady at 20.8% is what we are penciling in. The profit figure expected at 2,703 crores, and that could be a jump of 32% on a YOY basis. And also on the top line, we are expecting a 30% growth, a number close to 15,800 crores is what we are expecting. So definitely a 6 to 7% jump in the average selling price of the vehicle is what we are penciling in. There could be a higher mix of export of the three-wheeler and the premium two-wheeler segment, and both of these could help the margins of the company. So let's see what the delivery is coming in from Bajaj Auto. But apart from the numbers, all eyes will be on the buyback announcement as well, because do remember it's going to be the third buyback coming in from Bajaj Auto. How big is the size? What route the company will be adopting? These are some of the critical factors that we will be watchful of.
Okay, thank you so much for that, Srishti. Ashi, I wonder if you have a view with regard to IT at this point. I know you're playing some of these platform companies, the internet stocks in that fashion. But what about traditional IT? You have a good pulse of this space. You believe that there'll be big disruption there?
So I think the difficulty is it's just difficult to see. And that is what you're kind of seeing in terms of the stock prices and the levels of correction. What you don't know as of today in IT services is the kind of impact, the deflationary impact AI is going to have on the overall businesses. AI is going to make the employees a lot more productive. Therefore, the same employee can actually do that much more work, and you can probably get done a project with a much smaller team size. The general belief as of right now is that all of these productivity gains, the vast majority of this is going to be passed on to the client. Now, therefore, for AI not to have a deflationary impact, what you do need is a huge increase in workload. There is already a lot of talk about AI projects effectively coming on, and that could be a new source of revenue. But is there enough incremental demand that actually comes through to compensate for this deflationary impact in IT services? And I think that point is not yet clear. Every time you've seen a major technology disruption, there has always been a strong demand response. But is there going to be enough of a demand response to ensure that IT services can continue to scale off already quite high bases? I think until you don't have clarity on that key point, IT services as space is probably going to be largely ignored by markets. So that's our view, and we clearly prefer the internet platforms over traditional IT services companies.
Okay, so that is the take coming in on IT. Kunal, we've got a couple of minutes till we close. A quick reading on where we can expect to open tomorrow. Today there was expiry day pressure, but are you seeing a turnaround for tomorrow's trade?
Doesn't look like. I think we are stuck at the 24,000 mark, plus minus 200 points for the last 4 consecutive trading sessions for the indices. Maybe I think if we can break past about this 24,200 band tomorrow, then we can expect the markets to go into a stronger mode of a recovery. The only positive part, and I think that rather one of the better positive parts across the globe, is that the Asian markets have maintained that buoyancy over the last few days broadly. So that tells you that most of the other Asian markets going on strength, which means our markets could also stand to show maybe some signs of recovery going forward.
Shivangi, last question to you as well. What is it that you bet on as a sector, stock, theme, anything in terms of an idea that you can give us?
I think an idea that I'm looking out for the day is IRCON. We've seen a long consolidation and then a good amount of buying interest emerging at these levels. It had been making a very narrow range from the last 11 trading sessions. Weekly basis as well, it has kind of made a base formation here and then moved higher, comfortably holding above its key exponential moving averages on the weekly basis. So this one's on radar, and we're looking out for the next targets of around about 162 and a support of 156.
Okay, so that's the view coming in on IRCON. On that note, let's start winding down for the day. Shivangi, Kunal, as well as Ashi, thank you so much for your time. The viewers, about 1 minute left for the market to close. So just taking you through what the expiry day moves have been. Yes, we've seen some recovery from the day's low for the Nifty because at one point we were even struggling to hold on to 24,900. But we are now at 24,050 to be precise. It's a cut of 0.3%. Similarly, for the banking index, it's lower by about 0.6%. But the broader markets have seen some very good recovery of the day's low because you have a 0.3% uptick coming in on both the Nifty mid-cap and small-cap index looking good over there. The India VIX has cooled off further, now lower by about 3%. And if I take a look at what the sectoral movers are today, Nifty Realty, the top loser of the day, a 1.5% cut over there, followed by banks, finance and PSU banks. So the financial baskets along with realty, these were the two baskets that were under pressure. But on the flip side, Nifty Defense has done very well. It's names like Data Patterns that have done very well in trade, followed by Nifty Auto, FMCG, Pharma, Metals, Media, IT as well as Energy. Energy, in fact, is absolutely flat. But some of the auto names have done well. Of course, it was M&M on the back of its earnings that has done well. It's the top Nifty Auto gainer, followed by Anks like Tube Investment. So that also looks good. Hero Moto ahead of its earnings also looking rather chirpy. From the broader end of the market, the Nifty 500 is absolutely flat and the advanced decline ratio is also absolutely even Steven. Some of the top gainers include names like Credit Access on volumes up 12%. CAMS on very good earnings is up 9.5%. Titagarh Rail once again on volumes, as is the case with a lot of the railway stocks today. Wockhardt on the back of good numbers is up about 9%. Netweb, Sumitomo, Tata Tech once again on earnings is in focus. But on the flip side, deep pressure on Voltas is lower by 6.25%. CESE is lower by 6%. Mcure, Misho, Syngene, Aarti Industries, Ola, Godrej Properties, some of the stocks that were seeing a lot of a good gain coming in yesterday have seen massive profit taking and are all down between 5 and 6.5% each. So that is the take on how the markets have closed. In terms of some other positive news, it was EMS that has won a big order for itself worth 144 crore rupees. So EMS did well. It's up 7%. But yes, on the earnings front, it's KEI, IIFL, Aarti Industries, Raymond, Mcure that are under pressure on earnings. On the flip side, Marico, M&M, CAMS, Wockhardt, Tata Tech, AB Capital, some of the earnings that we've mentioned are doing well in response to what their Q4 earnings have been. But on that note, we're completely timed out on this edition of Closing Trades. The Nifty has closed with a cut of about 0.3% to be precise. But with that, it's a goodbye from Harsh, me and the team that put this show together. Thanks so much for tuning in.